What is going on, guys? I hope you are all doing well. Now, it's been a while since I've done a YouTube video. I already know what you guys are about to say. Where have you gone? Where have you been? You finally remember this password. But anyways, I'm back. And in today's video, I'm going to give you guys a valuable lesson. I'm going to take you guys exactly how to trade the power of 3, as that is the concept I used today to make just under £10,000 taking longs on gold, which I'm going to show you guys right over here. Anyways, let's get right into the breakdown. Actually, before we get into the analysis, let me break down exactly how we trade the power of 3. Technicals versus fundamentals, the age-old battle within the markets. Whether you're profitable or not, the ZMCX BMO collaboration is the place to be. For literally £20 a week, less than what you spend on junk food, you are flooded with value. Your mentors have 20+ years of experience. You have 100+ instructional videos to go through, daily live calls, 2 fundamentals breakdowns per week, daily institutional documents that would take you hours to find, monthly institutional guest speakers, and 24/7 fundamental and technical support, and much more, making it nearly impossible for you not to 10x that £20 investment. Of course, opportunities like this is extremely limited, which is why I urge you to click the link in the description to get started as soon as possible. So, very important things that you guys need to understand is the Asian range, London Open, and New York Open. Okay, as long as you understand the timings of these sessions, you can proceed with the understanding of this concept. So the first part of the phase is the consolidation, and this is usually during the Asian session. During the Asian session on majority pairs, we expect price to consolidate as there's not much volume stepping into the market. Right now, what is the theory behind the power of 3? Is that the Asian range creates both liquidity on the upside and on the downside. What does that tell us as traders? Now, if price was to sweep one side of the Asian range, that would mean there's still liquidity resting on the opposing side. So the idea behind the power of 3 is price must take out both the lows and the highs created during the Asian session. Now that we've identified this level as the Asian range, we anticipate that the highs of this range is a level of liquidity, and so is the low of the range. Now, with the understanding of this, we now anticipate that price must take out either side of the range during the London Open, and that's exactly what happened on gold. But on the in the gold scenario, it ended up sweeping the lows first. So price ends up dropping over to the downside during the London Open. Okay, now that the lows have been taken out, this area of liquidity right here has been swept. Therefore, this is no longer a level of liquidity we look to target, as price has already destroyed that low. However, the highs has still been untapped, meaning there's a lot of buy-side liquidity resting at the highs of the Asian session. With that in mind, that would give us the idea that if price was to displace and actually shift over to the upside, we can expect it to sweep that high. Now, this was the high that formed the low. What we would wait to validate our setup is for price to deliver a market structure shift prior to breaching the high. Once we get a market structure shift, people can call it change of character, people call it displacement, whatever you like to call it. As soon as price sweeps the Asian low and then it displaced, taking out this high that formed the low, that right there is enough validation that price is signaling for a reversal. So once we have that market structure shift, we begin to find our levels of supply and demand. Therefore, as soon as price delivers that market structure shifts and begins to pull back, that is when we begin to mark out our range. Once we have that market structure shift, guys, this validates the low. Therefore, we don't expect price to breach anything lower than this area, as it has officially formed a higher high. So as you guys can see, lower high, lower low, higher high, and then we expect a higher low. Okay, so once we filled up the low and the high, we start to identify our discounted levels, and you guys can see we have our 70.5 and our 79% levels right over here, as that is where we would expect price to drop to into our optimal trade entry, where we'll expect buyers to step in to take out the Asian highs. So the idea behind this concept, guys, is price sweeps either side of the Asian range first. In this instance, it ends up sweeping the lows. Price then displaces, pulls back into OTE. Once we have that mitigation at the 70.5 or the 79% at a discounted area of demand, we market execute and we target the remaining resting liquidity, which is the upside of the Asian range. Now that you guys understand this concept, let's apply it to the gold chart for the trade that we took today. So let's strip this naked, as inappropriate as that sounds. Anyways, as I was saying, now this is the Asian range. Guys, if you don't already know, the indicator that I use to identify the Asian range, the London kill zone and the New York kill zone is this Asian range and kill zones by NSR Group. One of the best indicators that you need to identify these very important ranges and sessions. So what ended up happening right over here during the London Open? So you guys already know this right here is the Asian range. Now that we've identified the Asian range, what do we know? The low of the Asian range is a level of liquidity, and so is the high of the Asian range. Both sides are areas of liquidity that we expect price to take out during the delivery of London and New York. Now, London session has opened right over here. This was market open for the London session. Where did price head towards first? Price ends up dropping and sweeping the Asian lows. Okay, so that is criteria number one met. Asian lows ended up being taken out. Now that we've identified that, let's identify the high that formed the low. So this was the high prior to this lower low being formed. So let's mark that out, as we would need price to breach this high to confirm the change in this market sentiment, to confirm that a reversal is now due. So let's continue to play price and see what exactly ends up happening. Now, as we had anticipated, price had breached this high. This right here confirms to us that we've officially had a change of character, meaning that price has begun its reversal and we can expect it to now come and sweep the Asian high. Now that we've identified that, let's wait for price to begin to pull back. And as you guys can see, once it breaches this low right over here, that confirms that this is the higher high. Therefore, we can officially begin to mark out our discounted levels. And so we mark out the low and the confirmed high, and we identify our discounted levels, which we have right over here at this level of demand in between the 70.5 and that 79%. So price swept Asian low. Then we had a market structure shift on the 5-minute, confirming that price is ready to sweep the Asian high. Once we've had that market structure shift over to the upside, we then wait for the pullback. As soon as price begins to pull back, you mark out the low and the high of the range, and you begin to identify your discounted levels of demand so that you can execute. Now that we've identified this level, that is when we begin to set limits at this level of demand right over here. Now, I'm just explaining in theory. I'm going to go through my exact entry point later. So by theory, we would have market executed at this level of demand with take profit at the highs and obviously our stops at the low of the zone. Price ends up dropping, forming some lows over here, some areas of inducement, which you will see price actually take out. So let's mark that out as a level of liquidity. Price ends up breaching that low and tapping into our discounted levels. Therefore, we should have market executed buys at this area of demand. I personally did not, as I wasn't actively trading during this hour. Price actually had left me and I had to scale in at a re-entry, and I'm going to show you guys that right now. So let's continue to play price and we'll see what it does. Price ends up moving over to the upside. Amazing. Once price got to this point right over here, that's when I identified that I missed out on an opportunity and now I need to look at an area to re-enter from. So as soon as price began to impulsively move out of this area of demand, it left behind this fair value right over here. And wherever there's inefficiency, we can expect price to fill in that level. Okay, so once price created this inefficiency right here and I saw that pullback on this candle, I marked out the candle at the inefficiency. There we go. This area right here was the point of entry for me personally because I got left behind. So as soon as price pulled back to fill in this little inefficiency, I market executed at the fill of the wicks. that was left untapped with my stops at the low of this candle. Okay, so if we continue to play price, there we go. Price has officially mitigated us in at the fill of the fair value and the mitigation at that wick high. That's where I personally executed my position, as I couldn't get that optimal entry point right over here. Okay, and as always, we target the opposing liquidity, which is at the Asian highs. Let's mark that out. Boom, boom, boom. And let's continue to play price. And just like that, price ends up rallying over to the upside. It pulls back, pulling into this previous structure. This is another valid entry point that you guys could have executed from. Guys, look, it's very simple. It's very simple order flow. Low, high, higher low, higher high, higher low, higher high. Okay, market moves in waves. So if you didn't get an initial entry here, no problem, wait for the re-entry. Didn't get an entry here, no problem, wait for the pullback, get in at the entry, and continue to ride price over to the upside. So as soon as price pulls back into previous structure, you could have taken in an entry with protected stops at the low, and as you guys can see, price just continues to rally from that point onwards, and it continues to fly and finally destroys our TP. So guys, this is concepts that you definitely must apply when you're trading. It's a very good concept to use, and it brings a more of a mechanical approach to your trading. It's very rule based. You wait for a sweep of one side of the liquidity, you wait for a displacement, you wait for a pullback into optimal trade entry, you take your position and you target opposing liquidity. Very simple, and this is definitely a concept that you should apply. Anyways guys, I'm gonna wrap up the video right over here. I hope you found it valuable. Guys, I will continue to provide value as long as you guys continue to show me support. So go ahead, like and comment on this video. Make sure you subscribe. Let's get 100K subscribers, as we are only 2K away. So let's make it happen, and I'll catch you guys on the next video. Take care.